In this video, traders, we're going to look at, should you consider hedging now for a market crash? If so, how would you do it? Stay tuned. Hey traders, warm welcome to you. All right, so should you consider hedging now for a market crash? So the answer is, I don't actually know. Nobody knows, right? No one can. You could sit here and I could give you a really good thesis as to why. I could say the valuations are so high. We've had a multi-year bull run. We haven't yet seen the effects of the coronavirus hitting the economy, blah, 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 blah. And the flip side, I could say to you, hey, there's plenty of money sloshing around at the moment. Money can go nowhere but stocks, get nothing in bonds. People seem to have so much money on the sidelines. The economy is going to recover quickly. There's the Fed money. There's all this money coming in from the central banks. And I could sit here and argue with you guys for 8 minutes about this topic. The thing is, you've got to make your own decision. You know, you either go, hey, I'm going to play for that, or I'm going to play the trend, or whatever. You know, and that's a commercial decision for you as a trader, right? I'm sure other people have got very valid opinions as to why. But ultimately, remember this, nobody knows. Nobody knows. They might have got it right before, they might not get it right this time. They might not have got it right before, they might get it right this time. You've got to make your own decision, and there's always going to be really, really good sounding bear arguments, really good sounding bull arguments. However, if you wanted to, then there's a way you could do it, potentially, that wouldn't cost you much if you're wrong. And we'll get to that in a moment, but let's consider how you could do this. So the first thing is the obvious one. You could short the market, right? You could just pick a market, let's say S&P 500, Nasdaq, Dow, FTSE, DAX, whatever you want to do, and outright short it. Now, this is probably my least favorite of the lot, because you're literally just stabbing at the idea that this is going to roll over. And you know, maybe it does, but maybe it rallies for another 9 months before it does roll over. And what you're going to do is keep adding to your position, keep adding margin, keep that position, and have a huge unrealized P&L? No, probably not. Are you going to come out with stops and get stopped out? You could do that, but then once you're committed, you're kind of stuck with the thing. If you're right, then great, you hit it right. But you've got to be, timing's got to be absolutely spot on for that, and you could take a huge amount of pain before it comes good. So I think that's a bit of a worst choice of the lot. Then you could identify sectors that could be hit. Now you're getting slightly better because you're kind of picking stuff that's a little bit weaker already, or stuff that you think is going to get hit the most, depending on where the fuel to the fire is going to come from. Is it going to be credit this time? Probably not. We've seen that before. Is it going to be something else this time? If you can identify where that is and preempt that, I know guys, easier said than done, right? But if you can, then you could probably put some lines of shorts out, some small shorts in those, because those stocks probably won't be very strong anyway. So you could kind of be more focused on the sectors. The other one is to short the frothy stocks. Now, I think this is a slightly better than the overall market. Again, timing, you know, tricky, but we're talking about the stocks that are just ramped on and on, like the Teslas. I'm not saying I'm bearish Tesla at all, but those kind of things that you think, if there was money flow just suddenly stopping and people pulling money out, where would that money come out first? Maybe it will come out, I mean, who knows if that's the case, but maybe it will come out some of the tech stuff first. Maybe it would go into something that's a little bit you know, more resilient, you know, in terms of cash flow. But then again, you know, the argument could be, well, tech's very resilient. So there's a huge high margin, maybe not Tesla so much, but you know, we talk about some of the Googles, the Amazons, etc. But anyway, the point is, you look for stuff that's super frothy, you feel that it's well overvalued, and you think if it's a mean reversion from a valuation perspective, then you know that's going to be your play. But again, timing is challenging. Right, now we get into kind of option strategies, and I won't go kind of too deep into different spreads that you can trade and different variations of options, but what I will say is this is something that you know, many funds are doing consistently and regularly because it's relatively cheap. The trouble you have with shorting stuff, just naked shorting, is that you know, like I say, you got to roll the thing over, you got a constant unrealized P&L. You could do something like buy out of the money puts on the market. So the broad market, let's say S&P 500, you could use a SPY ETF, find a put to a level you think it will go to, pick a strike price. That's an art in itself, but assume you pick a strike price and you pick an expiry date, and you don't pay a lot for it. You won't pay a lot for it while the market's chucking high. Now, of course, when the market starts to decline heavily, those puts will increase in value massively. And if it does really crash and goes through your level, you're going to make an awful lot of money. But the chances are, if it keeps chugging and chugging and chugging, eventually those will expire worthless and you'll lose your money. So you've got to be prepared for that. I think if you're picking that option, that's the cheaper option because you can go in small, you can go way out the money puts, and if a catastrophe happens, you get a spike in the value of the put, you can take some money off the table, take some profit. Buy VIX calls, another way of doing it is market volatility. If the market starts to crash, volatility will spike, those VIX calls will spike. Similar type of thing, but I think if you're not very familiar with the VIX and how it kind of trades, you're better off kind of picking what you want. Another thing is a hybrid of them all. So I think this is perhaps the sweet spot, is to go, right, let me have a look at some of the frothy stocks, so to speak, or some sectors that could be hit, whatever you think that is, and whatever you think the catalyst. If you think it's like another more pandemic catalyst, if you think it's running out of money, if you think it's jobs, if you think it's a shift from bricks and mortar to tech, have a look and say, okay, well actually maybe commercial buildings are the ones that are going to get hit the most. Maybe it's going to be these retailers that have just been hanging on by the skin of their teeth. They're going to be hit the most. All right, so maybe I then start to buy out of the money puts on some of these frothy stocks and some of these sectors that I think could be hit. So it's retailers, maybe commercial buildings, whatever your thesis is. And then you've got a small amount of money in, you're risking whatever the cost of the put is. If it goes to zero, you lose it. If it doesn't, you're going to make a lot of money from it, and you don't have to worry about managing it. If you're prepared to risk everything you've put and prepared for the put to go to zero, then you don't have to manage it anymore. You can put the trade on. Worst you can do is go to zero. The worst you'll lose is your investment. And you've been a little bit more clever than just shorting the overall market. You've been a little bit more clever than just buying puts in the overall market. You've kind of, sat down, sat in a chair and thought, where could this come from? What's going to get hit the most if the economy contracts, if the market takes a tumble? Where's the money going to come off the table first? Yes, you've got to be a little bit more right, but being a little bit more right means that you can add a potentially much more winnings to your trade if it comes true. So anyway guys, should you consider hedging now for a market crash, and how would you do it? Should you consider it? Well, if you think there's a chance the market rolls over this year, you can do it relatively cheaply. So you've got to decide, would I want to spend this money? I'm prepared to waste this money. I wouldn't say shorting the overall market. Now, I don't recommend anything, guys. You want to short the overall market, you do it, just understand the risks. The point is, if I was looking at a way to get short exposure, personally, I wouldn't short the overall market just like that, just on a hope. Now, difference is, very finally, guys, if we start to roll over and price told me it was a short, then I'd be all over the standard short. I'm just going to look at price. But if I just thought that for the next 6 months, 9 months, we'd roll over, I wouldn't take that approach. I might just pick this approach and prepared to lose some out of the money puts. And if they came good, they make me big money. If they didn't, I'd say, okay, I had a little go at it. Let's see what's going on in the rest of the market and see how the trades are done. All right, guys, that is shorting, and that is shorting the overall market. And also potential ways to do it. If you've got any other ways of doing it, thinking of other ways, clever ways of getting exposure to the short side that are relatively cheap but can pay off well if it comes in, let me know in the comment section below. Always interested to hear what you guys got to say. Take care. Bye-bye.